Greetings, intrepid explorers of the financial universe. Prepare to embark on a thrilling odyssey into the realm of capital structure theory, a cornerstone of modern finance that's anything but dull. We'll traverse the annals of history, unpack the practical implications, and spotlight the trailblazing theories that have shaped our understanding of this exhilarating subject. Debt versus equity, the financing showdown. Before we embark on this epic journey, let's get a handle on the basics. Debt and equity, the two gladiators in the arena of capital structure. In one corner, we have debt, a loan that companies must repay with interest, a classic case of, I scratch your back, you scratch mine. In the other corner, we have equity, which represents ownership in the company. When you buy equity, you're essentially getting a piece of the corporate pie. These two financing titans lay the groundwork for our adventure into capital structure theory. Balance sheet basics. Now let's take a quick pit stop at the balance sheet, a snapshot of a company's financial position. The balance sheet comprises assets, liabilities, and equity. Our focus here is on the right side of the balance sheet, where the magic of capital structure unfolds. The unique blend of debt and equity that a firm chooses will ultimately shape its financial destiny. Modigliani and Miller's propositions, the dynamic duo. In 1958, Franco Modigliani and Merton Miller, two financial superheroes, burst onto the scene with their groundbreaking propositions, which laid the foundation for modern capital structure theory. They put forth two earth-shattering ideas. Proposition 1. In a fantastical world without taxes, bankruptcy costs, or other market imperfections, a firm's value is utterly impervious to its capital structure. In simpler terms, the debt-equity mix doesn't make a lick of difference to the firm's value. Behold, the irrelevance principle. Proposition 2. In this utopian realm, a firm's cost of equity rockets upward linearly with its debt-to-equity ratio, ultimately implying that the weighted average cost of capital, WACC, remains unflinching in the face of capital structure changes. These propositions ignited a firestorm of research, birthing a new generation of capital structure theories. The tradeoff theory, a high-stakes balancing act. Enter the tradeoff theory, a brilliant response to the limitations of Modigliani and Miller's propositions. This daring theory posits that firms pinpoint their optimal capital structure by walking a financial tightrope, carefully balancing the benefits and costs of debt financing. On one hand, debt boasts a tax shield, thanks to tax-deductible interest payments. On the other hand, more debt means a higher risk of bankruptcy and financial distress, which can spell doom for the firm. The trade-off theory suggests that firms blaze a path toward maximum value by striking the perfect balance between the tax shield's allure and the perils of financial distress. The pecking order theory, hierarchy reigns supreme. Next up, we have the pecking order theory, a revolutionary brainchild of Stuart Myers and Nicholas Magaluf from 1984. This theory contends that firms follow a strict hierarchy when choosing their sources of financing. They favor internal financing, retained earnings, first, then debt, and finally, as a last-ditch effort, equity. The pecking order theory purports that capital structure decisions are steered by a firm's need for external financing and the relative costs of debt and equity, rather than by a fixed, optimal capital structure target. Market timing theory, striking when the iron is hot. Last but not least, we have the market timing theory, a brainwave from Malcolm Baker and Jeffrey Wergler. This theory suggests that firms issue equity when their stock prices soar and repurchase shares, or issue debt when their stock prices plummet. In essence, capital structure decisions are swayed by market conditions and the perceived mispricing of a firm's securities, rather than by some predetermined optimal capital structure. Conclusion. And there you have it, intrepid explorers. We've journeyed through the exhilarating world of capital structure theory, witnessing its evolution from Modigliani and Miller's trailblazing work to the revolutionary ideas that followed. As we conclude this wild ride, we hope you've gained a deeper understanding and appreciation for the thrilling world of finance that lies at the heart of capital structure theory. Which theory do you prefer? Which one is wrong? Which one is right? Let's have a discussion in the comments down below. Please don't forget to like this video if you found it helpful. This way, a lot more people will discover this video who may find it useful. Subscribe for more. Until our next adventure, fare thee well.